to Money Manager. I'm Lindsay Williams in the Cape Town studio, and with me is Liang from Prescient. We're talking about the Prescient China Balance Fund. We did speak to Liang around about 3 months ago about this very fund, but so much has gone on since then that we thought it right to get him back into the studio. What a time it's been. I mean, 2014 was great for the Chinese stocks. The first quarter and a half of 2015 has been even better.
Absolutely. I think year to date, in rand terms, the fund's probably up about 37%. That's a mind-blowing number. The Chinese equity market has gone from strength to strength. And following on last year's perhaps mini bull market, the run has continued over the first quarter.
Yes, it is. What are the reasons behind it? You were in China 2 or 3 weeks ago. First of all, what's the mood? Is it to do with the fact that there may be some more stimulus from the authorities, People's Bank of China, etc., or is it simply because there are certain regulations that have been put in which allow people to do things that they couldn't do before?
I think one of the primary causes is a shift of money away from properties into stocks. I think the theme that came through very consistently there, which I was quite surprised at, is that when you spoke to brokers who interacted with the man on the street who are depositing money into the stock market, what's happening is, according to their surveys, about 3% of Chinese households have their money in stocks. Now, a comparative number around the world from the US to South Africa, you're looking at about 20 to 40%. So what they've been saying is that they've had an 8-year bear market. No one has ever put any money into the stock market. Property markets have kind of peaked about a year and a half ago, and now they're seeing a change, but from the stock market, from the property market into the stock market.
So it's an asset class reallocation?
Absolutely. How much of that is true, we don't know. Of course, a lot of it is 140 million retail investors whose sentiment can change on a whim. But having said that, sentiment on the ground certainly has been quite good.
If you have a look at the makeup of the Chinese economy and its population versus between rather rural and urban, I wonder what the figure might be. You can say 3% across the population as a whole, but I wonder how many people in urban areas are holding stocks versus property. It's probably higher than 3%.
It's an interesting question. So I would actually guess that in the rural area people will have less stock accounts. So certainly I would think people in urban areas have higher stock accounts. But I think that 3% number was from the people who actually have stock accounts.
Yes.
So overall population, the number is probably lower in terms of people who actually hold stocks.
One of the things that people worried about, both at the beginning of 2014 and 2015 in China, was the property market, and was it a bubble? And you say that less people are owning property now. Does that mean that they have sold their property, they're not buying new properties? Because it's not the most liquid of assets, especially during times of depression, or rather property depression.
Absolutely. I think the case is actually because China has such a high savings rate that they're no longer buying new property at the same rate as before. So if you break down the China property market overall, I think tier 1 cities are doing quite well. So they've bottomed out and they're coming back. So I'm talking about your Guangdong, Shanghai, Beijing. And that's because kind of everyone in China, no matter where you're from, wants the property there. The tier 2 cities are still falling, but at a much slower pace, so they're more or less stabilized. But the tier 3 cities are where you're seeing the prices continue to fall, and they haven't stabilized yet.
The cities where they build opera houses and libraries and massive highways and 30,000 units, but nobody lives there.
A little bit like that, but like I said, tier 1, tier 2 cities are doing incredibly well. They certainly are folded up, and I'm seeing very strong.
Yeah, the tier 1 cities, I suppose, are the special economic zones, a couple of which you just mentioned. Let's talk about the economy first of all, because people, the scaremongers, and there's certain websites, and you know the ones I mean, constantly say that China is massaging its own numbers, and in fact, it's a basket case, and it will come. Its growth rate might be 2 to 3% rather than the 7 to 7.5% that is being published. What did you sense when you were on the ground there 2 weeks ago?
I must admit, when on the ground there, I was in the tier 1 cities, Beijing and Shanghai, and there you see an incredible demand. Every single shopping center you go to, every single food court, every single shop has a sign, help wanted. So even as speaking to the man on the ground, there's a massive mismatch of labor supply and demand. So a lot of people, as it goes toward a more services economy.
But blue-collar jobs you're talking about.
Blue-collar jobs.
Yeah.
So people cannot, every single place, that's the thing that blew my mind. It's complete contrast to South Africa, where if they advertise for a waitress, for example, you have lines around the block for people trying to get a job. In China, it's the opposite. Every single restaurant, every single fast food point, every single massage place. So kind of all the services economy has massive demand for blue-collar workers that in the tier 1 cities no longer have.
Yes.
So you just have a lot of graduates, university graduates. So I guess on that sense, it's pretty good. And what surprised me is actually the wages were quite good as well. We're talking about 8,000 to 9,000 rand a month to do these type of jobs.
Yeah, so it's not bad. I don't know what the cost of living is. It's probably a little bit more than we're used to in South Africa, but nonetheless, that's a good sign. Is it then a sign that the policy of the PBOC and again the authorities of China becoming a more consumption-led economy rather than a production-led economy is starting to work? Because if the services industry is booming, then it's exactly what they want.
Absolutely. So if you look at, for example, measures of services versus a measure of manufacturing, what you see is that services are booming and manufacturing is falling off a cliff. And combined, the economy is still slowing. So combined, the economy is slowing, but service sector are going through the roof. That's a good rebalancing. The previous model was unsustainable, and this new services economy has started to catch up. There's a lot of pent-up demand for services, a lot of pent-up demand for consumption in China, and that could grow massively over the next decade.
What does this mean? What are the implications for you as a fund manager of the Prescient China Balanced Fund? Because in the past you might have been looking at state-owned organisations that are making steel and churning and consuming enormous amounts of iron ore from Australia, but we know that's not the case anymore. Does that mean that you have to look at FMCG companies? Do you have to look at fast food outlets that are listed on certain exchanges? What does it mean for you?
I think crucially important is that a lot of it is priced in. So one has to always divorce the fact that there's certain sectors that looks fantastic and their growth prospects are a lot better, but they're priced for an extreme outcome. So that's already been priced in. So you have to kind of find a balance between the two, where perhaps some of the old sectors are not going to collapse as much as people expect them to collapse. And their pricing would suggest actually you have good returns to be made from that, and vice versa. Some of the other sectors will be great. I mean, don't get me wrong. So we talk about mid-cap to small-cap companies, for example, are showing earnings per share growth of about 48% on aggregate over the past year. And that's an incredible number. So there is this growth. But at the same time, they're trading at PEs of 55. So you've got to balance the two and have a good valuation framework before you buy shares.
Is it too much, or is it just a catch-up after 8 years of stagnation, a stroke bear market?
I think so far it's been a catch-up. So the pace has been insanely quick. We're looking at probably about 100% return over the past year. But that's been a catch-up. So it was trading at a PE of, let's say, 10 to forward PE of 9 compared to the rest of the world at 18. So currently what's looking at it's almost the same as the rest of the world. They're talking about maybe a 5% discount to the rest of the world, but no more than that. So the catch-up phase has been done. The next phase is to see, well, we still got the monetary policy support out of the Chinese central banks. At the same time, sentiment has started to change. If you look at historically, Chinese sentiment tend to ride for quite a long while. So if you have fair valuations, positive sentiment, and very loose monetary policy, I think it's perhaps a little bit too early yet just to cut it right now.
What do you like at the moment? What sectors?
What sectors? I think, look, you can't ignore the fact that there's problem in the financial sectors, but the financial sector remains the bulwark and massively, massively cheap. The consumers obviously goes without saying. You can still find some very high quality consumer stocks. You talk about companies with ROEs of 20%, growing at about 15-20% a year, trading at PEs of 15, for example. So they remain very, very attractive. But overall, it's not as easy as before. I mean, a year ago, you literally could throw a dart and buy something that's extremely cheap.
Yeah.
Now it's not the case anymore.
Are you slightly worried? Because I was worried on Friday afternoon. I was sitting watching my screen, and I suddenly looked at the futures market. And the futures market on a certain index had fallen by around about 5.5–6%. That dragged down the DAX in Frankfurt, that dragged down the Dow Jones futures, and everything. There was a sort of mini contagion in the afternoon. Of course, it's bounced back today. What happened there? What's going on?
So after the Chinese market closed on Friday, regulators released an updated list of stocks that can be shorted. So the Chinese market is already completely closed. The Hong Kong market is still open with the futures trading at kind of the midnight crew there. So I think people panicked a bit. So kind of they looked at this and thought regulators were tightening. I think regulation plays such a big role in China that people tend to overread into single actions, especially with limited news source. So they kind of read into it as regulators clamping down now, they're going to tighten. So they sold first. Of course, as market opened today, Reserve Bank requirement dropped 1%. It kind of just worked itself out and nothing happened from that. But I think you have to expect volatility in China. Just the nature of the market. There's a lot of sentiment. It has realized volatility of 35%. No equity market in the world can't even close. Most equity markets about half that. So something to be expected in China when you invest there. But having said that, the rewards can also be great, as we have seen over the last 12 to 24 months.
Yes, but you have to be fairly circumspect when it comes to these stocks. I mean, from what I understand, that the Chinese mentality does lean towards a little bit of speculation in here and there. And if we got to the point where, say, that 3% number that you quoted earlier on got up to more traditional numbers in the Western world of 20 to 40%, then the volume and the speculation is going to become absolutely enormous and could be destabilizing, not just for the Chinese markets, but also for the rest of the world.
Absolutely. But I think over time people also get more and more educated. So if you see now when they did a survey of the average Chinese investor, most of them barely have a high school education, right? They're not financially literate, but they do have money. They have massive savings and they've earned a lot of money. So they play a very large role in the economy. I think the next generation, for example, will be vastly far better educated and will understand the financial markets better. So I think you have the merge of the two, where people invest more and more in shares, but at the same time market will mature a little bit.
I think that if someone's got a lot of savings, they're very financially literate. I wish we had a few people that were financially literate enough to have saved over the last 10 years. Going short of things and being able to go long of things is one thing, but there's also something else that I picked up in the press, and it's sort of made me a little bit worried again. People borrowing money in order to go into the market, and also people shorting stocks and getting squeezed all the time. So sophisticated people saying these PE ratios and these traditional measures are flashing a few warning signs, and other people saying, doesn't matter, I think it was a figure of 1.06 trillion yuan had been borrowed in order to get into the market. Is that something you also picked up, a little bit of a frenzy?
Absolutely. So I think recently, for example, new stock accounts being created is at 10 times the pace it was a year ago. The previous peak, 100 million people in the stock market. Now it's about 140 million people. So we've certainly seen more participation. I think things like margin borrowing and stuff is far more difficult to quantify. So to put that into perspective, basically if you got R1 million in a stockbroking account, what they allow you to do is to borrow another 30% from that. So you can borrow 300,000 to invest, and they will margin call you once it's fallen about 60 or 70%, which gives them which gives obviously the brokerages still a margin of safety. Now that's been clamped down by regulators. So regulators have been monitoring that very, very carefully, and that's been the main source of kind of margin borrowing to do that. But to put into perspective, for example, in the US, the futures market is a lot bigger, the option market is a lot bigger, where margins take up only 5 to 10% of what you need to put down. So the leverage ratios are vastly different. So you're looking at two different markets, and it's very difficult to put that into context. But as I mentioned, the people have started to participate. They've had 8 years of bad markets, and they've just started to come through now.
It's very exciting, Liang. Tell us about the Prescient China Balanced Fund since we last spoke. Anything that you've been taking off the table, anything you've been adding? What's your strategy at the moment, given everything we've just said?
Absolutely. So our strategy has always been very quantitative. So we look at what happened in the past, and we believe that the market made systematic errors. So one of the things that not surprised us in the previous cycle, when we looked at the big market, bull market, value did very well. So that's a big surprise. So usually when market goes up 100%, value did very badly. And recently we found exactly the same thing. So this time around in this bull market, it's exactly our value model showing alpha about 20% over the last 12 months. Overall, when we looked at the lovely thing about having 140 million invested in the market is they make systematic mistakes. They ignore value, they overreact to news, they ignore quality, and we try to pick that up. And by sticking to our models, we've actually generated fantastic alpha over the last 2 years, looking at about 5% per annum, and we've done about 10% alpha over the last 2 years.
Keep up the good work, Liang. Thanks very much for popping in this evening. That's Liang Du, Portfolio Manager at Prescient Global Funds PLC, talking about the Prescient China Balanced Fund.